Welcome to this lesson, in which we provide an introduction to the main methods of capital budgeting. There are a number of capital budgeting models available that assess and rank capital expenditure proposals. Let's take a look at 4 of the most common models for evaluating business investments. These are the accounting rate of return method, the payback method, the net present value method, and the internal rate of return method. First, let's think about the main distinguishing features of each of the 4 methods. First, the accounting rate of return uses the accrual accounting amounts and takes into account the average of all years covered, or a specific year. The payback method uses cash flows, which are not discounted, and the time period is simply until all cash is recovered. The next 2 methods, the net present value and the internal rate of return methods, both use discounted cash flows, and both apply to the whole life of the project or program. There are, however, some differences, and in particular the IRR does not account for total risk of the investment, as we shall see later in this lesson. While each of these methods has its benefits and drawbacks, sophisticated financial managers prefer the net present value and the internal rate of return methods. There are 2 reasons why these methods are favored. First, all of the cash flows over the entire length of the project are considered, and second, the future cash flows are discounted to reflect the time value of money. The time value of money is the concept that a sum of money is worth more now than the same sum will be at a future date, due to its earnings potential in the interim. This is a core principle of finance. A sum of money in the hand has greater value than the same sum to be paid in the future. The time value of money is also referred to as present discounted value. If it is not invested, the value of the money erodes over time. If you hide $1,000 in a mattress for 3 years, you will lose the additional money it could have earned over that time if invested. Indeed, it will have even less buying power when you retrieve it, because inflation has reduced its value. Investors prefer to receive money today, rather than the same amount of money in the future, because a sum of money, once invested, grows over time. For example, money deposited into a savings account earns interest. Over time, the interest is added to the principal, earning more interest. That's the power of compounding interest. As an example, say you have the option of receiving $10,000 now, or $10,000 2 years from now. Despite the equal face value, $10,000 today has more value and utility than it will 2 years from now, due to the opportunity costs associated with the delay. In other words, a payment delayed is an opportunity missed. The accounting rate of return, or ARR, is a formula that reflects the percentage rate of return expected on an investment or asset, compared to the initial investment's cost. The ARR formula divides an asset's average revenue by the company's initial investment to derive the ratio, or return that one may expect over the lifetime of an asset or project. ARR does not consider the time value of money or cash flows, which can be an integral part of maintaining a business. In other words, $10,000 of net income in year 4 is considered to be as valuable as $10,000 of net income in year 1. The basic formula for calculating the average rate of return is ARR equals the average profit divided by the average investment, where the average investment equals the book value at the beginning of year 1 plus the book value at the end of user life, divided by 2. ARR calculates the return generated from net income of the proposed capital investment. The ARR is a percentage return. Say, if ARR equals 7%, then it means that the project is expected to earn 7 cents out of each dollar invested. If the ARR is equal to, or greater than the required rate of return, the project is acceptable. If it is less than the desired rate, it should be rejected. When comparing investments, the higher the ARR, the more attractive the investment. The payback period in capital budgeting refers to the period of time required for the return on an investment to repay the sum of the original investment. The payback period intuitively measures how long something takes to pay for itself. All else being equal, shorter payback periods are preferable to longer payback periods. Figuring out the payback period is simple. It is the cost of the investment divided by the average annual cash flow. The shorter the payback, the more desirable the investment. Conversely, the longer the payback, the less desirable it is. For example, if solar panels cost $5,000 to install, and the savings are $100 each month, it would take 4.2 years to reach the payback period. Unlike other methods of capital budgeting, the payback period ignores the time value of money, or opportunity cost. The net present value, or NPV, is the difference between the present value of cash inflows and the present value of cash outflows over a period of time. NPV is used in capital budgeting and investment planning to analyze the profitability of a projected investment or project. NPV is the result of calculations used to find today's value of a future stream of payments. NPV looks to assess the profitability of a given investment on the basis that $1 in the future is not worth the same as $1 today. Money loses value over time due to inflation. However, $1 today can be invested and earn a return, making its future value possibly higher than $1 received at the same point in the future. The NPV relies on a discount rate that may be derived from the cost of the capital required to invest, and any project or investment with a negative NPV should be avoided. One important drawback of NPV analysis is that it makes assumptions about future events that may not be reliable. The internal rate of return, or IRR, is defined as the discount rate that gives a net present value of 0. It is a commonly used measure of investment efficiency. Generally speaking, the higher an internal rate of return, the more desirable an investment is to undertake. IRR is uniform for investments of varying types and, as such, can be used to rank multiple prospective investments or projects on a relatively even basis. In general, when comparing investment options with other similar characteristics, the investment with the highest IRR probably would be considered the best. Computing the internal rate of return for a possible investment is time-consuming and inexact. IRR calculations must be performed via guesses, assumptions, and trial and error. Essentially, an IRR calculation begins with two random guesses at possible values and ends with either a validation or rejection. If rejected, new guesses are necessary. There are several methods for calculating IRR. One possible algebraic formula for IRR is illustrated here. We will discuss this and other formulae in the lesson on using IRR. In capital planning, one popular scenario for IRR is comparing the profitability of establishing new operations with that of expanding existing operations. For example, an energy company may use IRR in deciding whether to open a new power plant or to renovate and expand an existing power plant. While both projects could add value to the company, it is likely that one will be the more logical decision, as prescribed by IRR. Note that because IRR does not account for changing discount rates, it's often not adequate for longer-term projects, with discount rates that are expected to vary. An additional calculation, not always used in capital budgeting, is ROI. Return on investment, or ROI, is a performance measure used to evaluate the efficiency or profitability of an investment, or compare the efficiency of a number of different investments. ROI tries to directly measure the amount of return on a particular investment relative to the investment's cost. ROI is a popular metric because of its versatility and simplicity. Essentially, ROI can be used as a rudimentary gauge of an investment's profitability. This could be the ROI on a stock investment, the ROI a company expects on expanding a factory, or the ROI generated in a real estate transaction. The calculation itself is not too complicated, and it is relatively easy to interpret for its wide range of applications. If an investment's ROI is net positive, it is probably worthwhile. But if other opportunities with higher ROIs are available, these signals can help investors eliminate or select the best options. Likewise, investors should avoid negative ROIs, which imply a net loss. For example, suppose Joe invested $1,000 in Slice Pizza Corporation in 2023 and sold the shares for a total of $1,200 1 year later. To calculate the return on this investment, divide the net profits of $1,200 minus $1,000 equals $200 by the investment cost of $1,000 for an ROI of $200 divided by $1,000, or 20%. As we have seen, there are 4 common methods used in capital budgeting: the accounting rate of return method, the payback method, the net present value method, and the internal rate of return method. and there are others, such as the ROI method. In the lessons which follow, we will examine each of the four methods in detail and consider the advantages and disadvantages of each.
Want to learn more about this subject? Then click on our website to view the full course. Why not subscribe and get access to free articles and special offers? Join the Global Career Highway now.